because we never had the class during the day. A quick recap, ladies and gentlemen, and a cost of capital, and a cost of capital. So basically, we are looking at our capital providers. Our capital providers are who? For example, we have equity. Our capital providers, we have equity or ordinary shareholders. We have, in this case here, debt, the bond holders. And then, of course, we have what we call the preference shareholders. The preference shareholders, like that. All right. So when these guys here give us the equity, when of course they give us the equity capital, which form of return are we going to give them? When they give us equity capital, we shall give them what we call dividends. Here we shall give them what we call dividends. Here we shall give them what we call what here? Interest. Here we shall give them what we call dividends as well. Dividends as well, like that, dividends. So then it will be very, very, very important for us to measure the return. So then how do we measure this return? If I put this in layman's language, if, for example, today I give you a debt of 1,000, I give you a debt of 1,000 bob, and then end of the month, I tell you to return this debt back with interest. So I tell you to return, for example, 1,100 to me. So then that means that my return in this case here, my return will be the interest that you have paid, this extra amount you've paid on top of the 1,000. So it will be the interest over what I gave you, over the debt amount, over the debt value. So whenever we look at this thing like this, it becomes very easy for us to understand. An investor has put in how much? An investor, for instance, has put in, say, 1,000 in form of buying your shares. And then you give them what here? You give them a dividend of, say, 20 bob. So then the return to him will be 20 divided by the market value of the share. Divided by the market value of the share. And that is, ladies and gentlemen, we went ahead and they said something very, very important here. We said, and for example, under equity, this is what we said under equity. Under equity, under ordinary shares, to get cost of equity, we said we'll be taking DO. All over what here, somebody? All over PO. You remember very well. We shall take, in this case here, how much are these guys going to earn today? It is DO. How much have they invested today? It is the market price per what year? Per share. It is the market price per share. But again, remember, these dividends, especially the ordinary share dividends, are never constant. These guys here would expect their dividends here to be growing. If you want, we call it signaling effect. If you would want more investors to invest in your farm, then you must always ensure that the existing shareholders are happy. You are giving them increased dividends. And that's why we say, ladies and gentlemen, if it is cost of equity, we shall come and talk about the best thing here is that we are looking at the dividend as the return divided by what year? The amount they have invested today. All right. But now remember that these returns, ladies and gentlemen, will be coming to us at the end of what year? At the end of the year. So therefore, this DO must always grow. So this DO must always grow. If there is growth rate, this DO must always grow. The DO must always grow. If I write this formula like this, that this is the cost of equity, the cost of getting equity amounts. Will I be right? There must be something I'm missing out here. Is there somebody who can tell me, what do you think in this case should I bring and add here to be able to get the correct cost of equity? Somebody who is able to give me the proper cost of equity. Yeah, very good. So in this case, we must come and add what here? We must come and add G, an independent growth rate like that. An independent growth rate like that. And then, ladies and gentlemen, remember, at times, equity shares, you can't get money that easily. You guys, you don't read Business Daily, and neither do you normally watch lots of what news or the TVs, finance news. The only news that I know you watch so much, like now today, everybody's watching the Gachagua thing. People don't watch finance news. If you are watching finance news, you must have seen situations where whenever a company wants to issue new shares, be they rights issue, right? Rights issue are those shares which are issued to existing shareholders at a discounted price. A company has to go an extra mile to market those shares. They must produce prospectuses. They must put, in this case, advertisements on the dailies, all right? At times, in this case, like, for example, you must have seen when the Eurobond was being sold outside there. At times, in this case here, you have to bring in very beautiful girls, put them, in this case here, in a very nice caravan, moving around town, in this case here, with lots of noise, loudspeakers here, singing, in this case here, giving us some great songs. And those ladies are dancing. Whenever they're dancing like that, they bring, in this case here, a crowd, and then at the end of the day, you are able to get a chance of speaking to people. So it means basically that at times, if, for example, you're going to sell this share at 100, you can't get 100 exactly in the market. You must entice people. So in this case here, we shall have what we call flotation. We shall have what we call flotation. We shall have what we call flotation. This one, we were able to look at this very well in our last class, and I would really beg that you get some time and revisit this area. Otherwise, today, I only have one objective. And the moment we finish this objective, we go to sleep. We've got no much business here. We said we are going up to morning, but what if these guys here understand what I want to teach in 10 minutes? If you guys understand what I want to teach in 10 minutes, would you want me to keep you waiting here? Would you want me to keep you in class? If you understand whatever I want to teach you guys in 10 minutes, don't you think it would be fair for us to simply just go and sleep? Anyway, this concept will take you more than 2 hours. So today, we have 3 sources of capital. We have finished, in this case here, accounting for cost of equity. Remember, to the return to the shareholders, then they call it returns. But we who raised funds from these shareholders, it will be a KE, it will be a cost of equity. So today, we want to look at cost of what here? Cost of debt. Cost of debt. So this is what we call KD. Cost of debt is what we call KD. Are you able to see my board really very well? Please give me a response here. I don't think so. To me, I'm seeing lots of light here. Do I reduce this light a little bit, or are you comfortable? No. Let me just do some adjustment. I hope now it's much better, right? Yeah, much better. I always like you guys to get the best experience, really. That's why I was waiting for your feedback. Yeah, thank you very much. Now, this examiner has now started becoming tricky and cheeky, and we must be able to know how to catch him. Now, when we talk of cost of debt, we know that we have got 2 types of debts. So tell us that there are 2 types of what here? There are 2 types of debt instruments here. 2 types of debt instruments. So number 1, we have what we call irredeemable. And then number 2, in this case here, we have what we call redeemable debt. So irredeemable debt, and then number 2, we have what we call redeemable debt. So now I want you to open the book that I sent to you, the ACCA book. Do you still have it? Do you have it? Do you have that book, the ACCA book? The ACCA book, do you still have it? Yeah. If you have it, somebody can hang it up here, or somebody can still resend. Thank you so much. Caroline needs it. Can somebody in this case here send this book on your WhatsApp group? Somebody send it. Send it there, somebody. Send it there. Send it there. Send it there. Now, so cost of debt, I don't have to explain this. Yeah. So I'm looking at irredeemable debt. Irredeemable debt is debt that is never repaid. Debt which you can carry forward. Like most Kenyans in this case here live on this redeemable debt concept. Of course, at the end of the day, the guys will tell you this case it's a 5-year loan. But after you've done like say 3 years, you go back and in this case here ask for more money. So always this thing becomes what here? A rolling stone. So then if it's a rolling stone, ladies and gentlemen, we know this is what we call infinite. Infinite. So it's what we call infinite here. It's what we call infinite. All right. Of course, you're told here it does not exist in practice, but in the examination, you assume debt to be irredeemable unless told what here, unless told otherwise. Because what will happen, ladies and gentlemen, under irredeemable debt, you will not be given N. You see, like now, redeemable debt here, they'll tell you that you have to return some people's money, say, for example, at the end of the 5th year. So you'll go and get a question where they're telling you that ABC has taken a loan of 10 million at a 10% interest rate without N, without maturity period. So if maturity period is not given, then you shall always assume that that debt is what here is redeemable. Is redeemable. And if it's redeemable, ladies and gentlemen, then N automatically is what here is infinity. In our very first class, if you can remember, we spoke about this infinite thing. Is there somebody who can remind us the formula of getting, in this case here, present value when N is infinity? Anybody who is able to remember the formula of getting present value of some amount payable every year, but where N is infinite? Where N is infinite. Where N is infinite. Anybody who is able to remind us the formula? Yeah, so 1 over R. Yeah. So remember that is what we call PVFA, right? PVFA. PVFA is 1 over R. But generally, if I'm told in this case that this amount will be given to us every year, indefinitely, then I'll take the amount and then I divide by what just to get the total present value. What you guys are giving me there very brightly is what we call present value interest factor of an annuity when N is infinity. When N is infinity, this is what we say. PVFA, when N is infinity, is 1 over R. But whenever I want to get the total present value, when N is infinity, it will be amount over what year? Amount over R. So ladies and gentlemen, have you written, this is the formula I want you guys to be remembering. Have you written it? Have you been able to highlight this in some way? Have you been able to highlight this in some way? Is there somebody who has been able to highlight this in some way? Anybody who has been able to highlight this? This is a very, very important formula. Very important formula. Present value when N is infinite, when they talk of perpetuity. So then, because I want us to look at this one here, number 1, irredeemable debt. So under irredeemable debt, we are saying basically that N is what here? N is infinity. And for us to be able to get, ladies and gentlemen, the current value. Call it present value. Present value when N is infinity. When N is infinity, it will be amount over what here? Amount over R. But they want you to make R the subject of big. But just to mention there, make R the subject of the formula. Make R the subject of the formula. So if you make R the subject of the formula, so you cross multiply, then this R will be amount over present value. Amount over present value. Amount over present value. So remember, the investors are calling it R, required return. But ourselves, in this case here, we are calling it what here? KD, because it's a cost of debt. It's a cost of debt. i.e., KD will be equal to, KD will be equal to, we are calling this one here amount, divided by what here, first of all, divided by present what here, divided by present value. I want to make this thing very clear to everybody, So when we talk about this amount, if these guys here invest in a debt instrument, which amount are we going to be giving these people every year? The amount which we'll be giving these people every year, which is now in perpetuity, will be called interest. In short, ladies and gentlemen, I'm trying to drive something very, very important here. So when we talk about this irredeemable debt, our KD basically will be interest over market value of debt. So don't use the present value. I'm trying to drive at something. So KD will be the interest we shall be paying to these guys over what they gave us. They bought our bond items, our bond instruments as a market value. Now I'm going to somewhere here. Listen, you and I, we happen to be knowing that interest is tax deductible. Unlike preference dividends, unlike ordinary share dividends, dividends are never allowable for tax purposes. But interest is always tax deductible. So you're saying here, I'm driving at something, that KB will be interest, so then we take care of the tax deductibility. So we have here interest all over what here? All over what we shall be calling MVD, like that, or MVB, market value of debt. If there are any flotation costs, you shall deduct from the denominator, because they're giving you the bond at market value. If there are any flotation costs you incurred, you shall deduct. If there are any discounts, you shall do what here? You shall deduct. If there are any discounts, you shall deduct. So I don't want you to remember everything that I've done, ladies and gentlemen, to derive. There is nobody who will ever ask you to derive these formulas. Nobody. Actually, if you ask me, whatever I've been doing there to derive these is very useless. Very useless. I would have even struck this off. But most importantly, ladies and gentlemen, whenever we talk about KD for what here? For irredeemable. KD for irredeemable. KD for irredeemable debt. Irredeemable debt. The normal bank loans. Those loans, in this case here, without a maturity period. Loans without a maturity period. Loans without a maturity period, where N is infinity. All right. Then my KD, my cost to this firm, I'll be paying these great ninjas who have given me this loan money. I'll be paying them interest. And this interest in this case here must be tax deductible. If the rate of tax is given there, so I must come and take away the tax. All over the market value of debt that these guys gave me, minus any flotation cost, minus any discounts. Please write this is discount. F is what here? Flotation cost. If I were you, and for example, I'm a member of UDA, I will use in this case here a yellow highlighter to highlight this. This is what is expected here. You can forget about the other useless things. That the cost here, these guys, I'll pay them interest, and they're giving me this money called what your market value. Of course, this is only multiplying by 100. So up to here, are we together, ladies and gentlemen? On Dr. Victor, are we together up to here? Are we together up to here? Are we together up to here? Please write these things in full. Somewhere there are days I get students calling me at 12 midnight. So I even think that they are calling me for some very serious business. All right, like what they do in this money market, what we call overnight lending or something. I mean, great business. For somebody just telling me, having gotten me out of my great slumberland, then they ask me, Mwalimu, what does this MVD mean? What I'll do, I'll simply, before I hang up on you, I'll tell you this stands for Mudavadi. Because you must write these things in full. All right, because 2-3 months down the line, when we'll be revising these things, you'll not be able to remember. MVD stands for market value of what here? Market value of debt. This stands for market value of debt. Market value of debt. So, ladies and gentlemen, have you been able to really write there like F stands for flotation cost? I don't think so. You guys today are not really talking. I don't know why. Flotation cost. D is the discount you give. So if a share is worth 100, you give a discount of 10. So that, of course, reduces your proceeds. All right. Then you have this book, my great students here. You have this book. Every student must be having this book. This book is a savior. It's a savior. You can see here FPLC has in issue 8% irredeemable debentures quoted at 90 X interest. Leave alone this. This does not really matter. X interest. What is the return to the investors? What is the cost to the company if the rate of corporation tax is 30%? Great question here, ladies and gentlemen. I will be able to just twist it a little bit here. So remember, they have told us the market value of debt is 90. So if market value of debt is 90, what will be the company's bond par value? What is our par value? What is our par value? You must have been told this in class. You know, par value basically is like the 100 note. The 100 note. So when you have your 100 note, this is the par value here, 100. So you are told that if this is 90, of course, the nearest, this will be 100, like that. 100. So the par value there, nobody will tell you that. The par value is 100. Listen, if you go to a question and then realize the examiner is telling you that the market value of debt is 800, market value of debt is 800, what will be the par value? What will be the par value? Your market value of debt is 800. What will be the par value? $1,000. 1K. Thank you very much, Eric. 1,000. 1,000. And then they have given you here the rate of interest. They have told you rate of interest is 8%. Is 8%. Is 8%. So the amount of interest, remember interest rate will be constant, which is 8%. So it will be 8% of the par value, because pi is ever constant. Remember, the interest that you pay every year will be the same. If you take 8%, you multiply it with the market value, you'll be cheating yourself, because market value keeps on fluctuating, and yet interest rate is supposed to be what you are fixed. So anytime you want to get amount of interest, you take the coupon rate, the 8%, you multiply it with the par value. So 8% with 100, that will give me what here? 8% with 100. So 8% with 100. This will give me Kenya shillings. Let me just allow me to use Kenya shillings to avoid confusion. This will be Kenya shillings what here? Kenya shillings 8. All right. So that makes me very happy. Is it 80 AAA? Use your calculator. Or they're saying it's 80, eh? 8% over 100. Is it 80? Where are you getting 80 from, you, my great daughters and sons? Allah. Allah. Are you using 80%? Or are you using 8% of 1,000? This can't be 1,000 because they have given us market value is 90. So the par value must be 100. Par value must be 100. So in this case here, the amount of interest is Kenya shillings 8. Therefore, I will be able to come and give it, in this case here, I'll be able to come here and give it, in this case here, our return. So the first one here, they want return to investors. Return to investors. So remember, investors don't enjoy any tax waivers. I.e., my return, the investor's return, basically will be the interest divided by what here? MVD. The interest divided by MVD. The money they give. So remember, R is a return. So the amount of interest here is 8 over market value of debt. The amount they gave you is 90. Whatever we get times 100. So remember, when they tell you the required rate of return for the investors, remember, it is us who will be able, as a company, we will be able to get a tax deduction on our income statement. But the investors themselves on the other side, their return, they can't get any tax waiver. So when you are given tax is 30% in the question, when the examiner tells you to get a required return from the perspective of the investor will not be able to take any tax advantage. The investor will not incur any flotation cost. The investor will not incur any discounts. The investor, you simply look at the amount of interest you are getting, you divide by what you gave out. As simple as that. If you look at the question at 8.89, if you look at the questions and gentlemen here, this question is very categorical and you can easily miss a step here. You can easily miss a step here because the examiner is asking you, what is the return to investors? Yeah, it's KD, but what is the return to the investors? And then number two, what is the cost to the company if the rate of corporation tax is 30%? Now they want us to give them the KD from the perspective of the company. So from the perspective of the company, so now we are answering number two. So from the perspective of the company, now we are answering number two. So from the perspective of the company, I know number two. KD from the perspective of company. So company, of course, will get a tax waiver on the interest paid. And of course, if we incur any flotation cost discounts, that must be deducted from the market value of debt. So KD here will be interest into 1 minus tax over market value of debt. If they incur any flotation cost, right, that has to be deducted. If they are going to give any discounts to potential bond investors just to entice them, then automatically in this case, that discount must be deducted. So then the rate of interest, ladies and gentlemen, here you guys have told me, not the rate per term, is 8 times 0.7 all over market value of debt, which is 90. Where am I getting 0.7 from? Because of 1 minus taxation. And tax, they have told us, is 30%. Tax, they have told us, is 30%. Tax, they have told us, it is 30%. You guys are not really talking to me. 6.22. 10 gives me 6.22. You guys are not really talking to me. I shall overcome. 6.22. So you can see here, the first one, the correct answer is 8. Remember at the back of that book, there are answers there. The first one was 8.89. Then we have here 6.22%. Ladies and gentlemen, without getting a very strong foundation in this financial management paper, I'm telling you, the examiner here is out to really ensure that you shall delay in the system. It's very, very unfortunate. And that's why I'm taking time to explain. And please don't shy away from asking Mwalimu several questions, because you need those foundations. Don't assume that this thing is very simple and then you just go there, like last semester you're just doing, and they tell me, Mwalimu, out of the 5 questions, yes, they were very difficult, but at least I'm so sure that I'll get 3. I tell you 3, I mean, those are very many marks. 3, if you get those correctly, that's a pass. When exams come, and then you start blaming village witches, your village witches. No, there's a concept you never understood very well. That is why I believe it's a special vision class. I'm taking my time to lay the foundation. So please feel free to ask what here questions. Yes, Tessie, yes. Feel free to ask questions here. Like that concept of power value. When power value is 90, 80, like that, Or rather, when market value is 90, 80 like that, then automatically we'll be taking the nearest, like 100, I mean. Well, it's 800, 900 like that, so par value will be 1,000. Now, please listen. We shall go straight away to number 2. Now, where we have what we call the redeemable bonds. The redeemable bonds. The redeemable bonds. Now, basically, easily put, redeemable bonds are bonds with a maturity period. These are bonds with a maturity period. Bonds with a maturity period. So, for example, when you open your past paper, the paper they gave you last semester, I'm so sure there guys will not even want to see it. But it's life. Life is like that. Life is like that. Is there a question I've missed? Just allow me to just squeeze this very fast. So if you look at, for example, ladies and gentlemen, this question here, this is Citrax Limited. This was your question number 2 last semester. And I would want us to look at note number 5, just a shortcut here. The finance director proposes to decrease the WACC of Citrax Limited and hence increase its market value by issuing 40 million bonds at their par value of shillings 100 per bond. These bonds would pay annual rate of interest of 8% before tax. And they would be redeemed, you can see redemption, at 5% premium to par after 10 years. All right. So they simply wanted us to get KD. This was a straight away 3 marks. This one I would have gotten those like 3 marks in this case here with my eyes closed. Why? Because I know the formula. I know the formula. Not many students were able to get this question correctly. So then the first thing I will do, if it's a redeemable bond, I will have to write the formula. So write the formula. And this formula is very, very confusing. Give us what we call the yield to maturity. Yield to maturity. Yield to maturity. So this formula normally comes in 2 ways, depending on what you are given. So like this is a share which we are buying at 100. The par value is 100. And then in this case here, during redemption, we shall be able to get something on top. Precisely, it is 5% on top of the 100. So precisely, the redemption value, so in this case here, redemption value is 100 times 1.05 because they shall return 5% on top. So 1.05 times 100. So then this will give me what amount, ladies and gentlemen? This will give me what amount here. So 100 times 1.05, this gives me 105. 105. And then we have our buying price. You can see we are buying this at par. Yeah, so the buying price is at par or face value of 100. So whenever you're buying at par, at times you could get a situation where the market value is a bit down, like 885, like that. Here we are buying at par, and then redemption in this case here becomes what? Here becomes 100. Then the formula here shall change slightly. So to get our yield to maturity, our YTM, our yield to maturity, if you allow me to grab this a little bit, just to create more space here, because we are discussing things, great things here. So in that case here, our yield to maturity will be interest rate. The rate of interest, right? Then you say plus market value minus par value. You divide by N over market value plus what here, somebody? Par value. This one you divide by 2. You divide by 2. Can you kindly write this? I'm so sure you are used to that formula, which most of you are using, and you ended up getting a 0, where basically we divide everything. Where we take the interest amount here, plus the capital gain. And then you divide everything with this. That formula normally happens whenever you're buying a stock item, a bond item at a discounted price. At a discounted price. Otherwise, when you're buying this thing at exactly the par value, this is how we shall be getting this. And then, of course, because it's a bond item, my KD will be KD after what year? After tax. I'll be able to just tax later. So first of all, write this formula up to here, and I'll be able to show you why everybody moving forward, we shall not be using these formulas. They are very useless because in this case, they can mislead you. You can end up getting a 0, and yet you are a very good student. Yet you are a very good student. All right, let me see their charts here. But you'll have to allow me just to finish this, and then I come back. It was quoted. I'll come back to that question, please. I can see somebody asking a question there. Just allow me to finish this. So are you able to see the rate of interest in this question? Is there somebody who is able to see the rate of interest? Yeah, 8%. Thank you very much, Walter. 8%. So the rate of interest here before tax. Yeah, 8%. 8%. So this is 0.08. So you write as 0.0 because it is interest rate. So this is 0.08 plus the market value. Of course, we shall be able to get in this case here 105 during redemption. Remember, this is the value at redemption. Minus the par value, we bought this thing at 100. We average this capital gain. On this capital gain, you bought at 100, you shall be getting 105. So you have your capital gain. So I want capital gain per year because this has to be per year. So then I have to come and divide this with the number of redemption years, 10 years. And then I'll be able to come here and take the average. You know, this average investment. So market value is 105 plus par value over 100. Then we divide this by what year? We divide this by 2. We divide this by 2. We divide this by 2. So here you must go slowly. Remember, this over is not touching this. This key thing here is independent. This key thing here is independent. So this will be 0.08 plus. So this is 105. This is 5. 5 divided by 10 is 0.5. 0.5 all over. So this is 205 divided by 2. That will be too heavy for me at my age. I don't want to struggle. My age now, I just need soft life. So can somebody in this case here give me? No, don't work with interest amount. Is this Sarah or who is this? Yeah, remember here we are working with interest rate. This formula you work with interest rate. Interest rate. So this one here gives me 102.5. So then pick your calculator. You say 0.08 plus 0.5 divided by 102.5. Tell me what you're getting there. You see, you say 0.08 plus 0.5 divided by this, and then you say equals. Then you say equals at the end of the day. You say equals at the end of the day. You say equals at the end of the day. Magnitude 1 0. Thank you so much. 0.0849. All of us, are we able to get this figure? All of us, are we able to get this figure? I would want to be of help. And for me to be of help, I want us to move together. We're not able to get, then I'll be able to pick my calculator, we punch, we see where the problem. Yeah, you can convert it to a percentage, yes. So then if it's percentage, this is 8.49%. Thank you very much if you want it like that. But of course, you haven't yet finished because now you'll have to come and give us KD, which now will be the YTM into 1 minus tax. So this will be 8.49 or whatever figure you have there times, I suppose the tax rate given there is 30%. Elizabeth, thank you very much. John Kirathe, thank you very much. Sarah, thank you very much. Yeah, so you see the tax is 30%. The tax rate given here is 30%. The tax rate given here is 30%. Corporate tax rate is 30% here. Again, remember, if corporate tax rate in finance is not given, you should always assume it to be 0. You should always assume it to be 0. You should always assume it to be 0. Yeah, somebody's giving me 5.9 something. 5.9 something. Somebody's giving us 5.9 something. 5.9 something. Which is approximately, yeah. Yeah, right, great. So in this case here, the KD, you can also see from the examiner's perspective. From the examiner's perspective, they got this 5.9 something. Somebody who rounded off, some funny, also getting 6 point. But at the end of the day, they chose to work with 6%. So you're getting 5.94, which is approximately 6%. Approximately. Now, I want you to be very honest with me. The students who tried doing this paper, were you able to get this part correctly? Be very honest with me. Because at times we keep on blaming KASNEB, and yet it is their concepts that you have not grasped very well. If you're able to remember what you did you get this correctly? Yeah, I like the students in this case who are telling us the truth. Yeah, because I'm so sure you may have used that as a formula when you buy shares at what at a discount, and we don't want to be using this. This is the last time I'm speaking about this formula. This formula, if I were you, actually I would have just blocked this and then written there on top in red, useless, most useless thing ever. This one will take you to hell. Very useless method. Very useless method. I will never use it. I will never use it. The method that I will always be using, which of course we normally teach the advanced level students, I always even don't show them this. Method two, for redeemable bonds, we shall always use IRR method. This one is a sure bet. IRR method. Yeah, Kiratha will be able to share this. We shall always use IRR method. So the students who are in the normal class, have you done NPV concepts yet with your teachers or not yet? That one now will be my worry with you guys who are in the normal class. When I bring you to my special class, what of those topics you haven't yet covered, and yet this is not supposed to be a usual ordinary class. But have you done NPV? Have you done NPV? Margaret says no. In the normal class, no. Not yet. Am I the very best person then placed to introduce you to NPV? I don't know. May God give me the grace. May God give me the grace here to go through this NPV. Okay, we shall overcome. We shall overcome. So tell us there that there are two types of cash flows, right? There are two types of cash flows. There are two types of cash flows. Because now I've accepted to carry you. Your birds that have chosen me as your tree. Who am I to refuse? Who am I to chase away? Birds to the blessings. So I have to simply accept the burden, and then I say how to carry you. So there are two types of cash flows. So number one, we have what we call irregular cash flows. And then we have what we call regular cash flows. So irregular cash flows use PVIF to discount. Use PVIF. I'll tell you what PVIF stands for. To discount. This one here use PVFR to discount. Use PVIF to discount. Regular use what we call PVFR to discount. PVIF stands for present value interest factor. And for us to get this PVIF, we shall be taking 1 plus R raised to -1. It's a formula you have to cram, because also nowadays your examiner doesn't give you some figures on the tables or the discounting tables, so you must cram this formula. Present value interest factor, it will be 1 plus R raised to -n. 1 plus R raised to -n. So whenever you get irregular cash flows, we shall be taking 1 plus R raised to -n. Raised to -n. All right. And have you guys, by the way, followed Mwalimu here on YouTube? Have you followed Mwalimu on YouTube, Joshua Aura YouTube channel? Have you followed Mwalimu? Have you been able to subscribe to Mwalimu's channel? If you haven't, then you don't know what you're missing. You need to look for Joshua Aura, the one that has got about 28,000 subscribers. You subscribe. Ring that bell. Whenever I put something new, you should be able to get a notification, right? Because like now I've done this topic there very well, very well. If you just look for discounting Joshua Aura, you're able to get me there very well, very well. So Joshua Aura, like this. Joshua Aura, CPA Ninja, the chief CPA Ninja, like that. Yeah, on YouTube. And then now we have what we call PVFR. So to get PVFR, ladies and gentlemen, how do we get PVFR? We normally say 1 minus the PV formula. 1 minus the PV formula, which is 1 plus R raised to -n. Then everything to be divided by what here? Everything to be divided by R. Yeah, so you subscribe to YouTube, you simply search Joshua Aura, the one that has got 28,000 followers. There's another guy who is trying to have an account with my name, but you don't, they're trying to look for some livelihood. So I think they have about 200 or something like that. Don't subscribe to their channel. You subscribe to my channel, the one that has got 28,000. Next week it shall be 30,000 because of you. All right. So whenever we talk of PVFR, which is present value interest factor of an annuity, I hope you're writing this in full. Present value interest factor of an annuity, it is 1 minus 1 plus. It is 1 minus this one here. And then everything to be divided by R. Everything to be divided by R. Everything to be divided by R. R is a required return. Don't forget that. Ladies and gentlemen, from there, I would want us to look at an example directly then before I do this question using method 2. So assuming we have what now here? Assuming we have our years 1, 2, 3. Then let's start from 0. Then we have our cash flows. Our cash flows in this case here, we have 100 here. Negative. Negative why? Because today we are investing. We're investing 100. Then we have in this case here, year 1, we get 50. Year 2, we get 40. Year 3, we get 30. And then we are given COG. COG is 8%. COG is cost of capital. COG is cost of capital. Thank you so much, Lorna. Great. Elia, 28.5. Great. Thank you so much. Yeah. COG is cost of capital. COG is cost of capital, which is 8%. So we are required here to calculate net present value. Net present value. We are required to calculate net present value. That shall be calling NPV. That shall be calling NPV. That shall be calling NPV. Fortunately, you did these concepts in high school. If you were good in mathematics, you can remember amount equals principal into 1 plus R. Those things, you did them in high school. All right. So it shall be a very simple thing. Don't tell me that Molimo, I did mathematics a long time. I'll remind you here. That's my responsibility. I just want to tell you that this is not even a hard thing at all. So let me ask you a question. What type of cash flows do we have here? Are these cash flows regular or irregular? Are they regular or irregular, these cash flows? They're irregular, yes, because you can see they are fluctuating. If they were uniform, for example, you're getting 80, 80, 80, 80, 80 every year, the same, then I would have said they are regular. Regular, we call them annuities. Annuities. If they are regular, don't write this, but if they are regular, would have called them annuities. Annuities. So because these are irregular, then we shall use PV. Because they are irregular, we shall use what here? We shall use PV to discount them. And remember, our PV formula is 1 plus R raised to negative n. So if I just come down here, my friends, I know PV is 1 plus R raised, so it is 1 plus 0.08 raised to negative n. Where am I getting 0.08 from? Because of the 8%. Because of the 8%. All right. So then I'll be able to come here and write 1.08 raised to negative 0. This is 1.08 raised to 1. 1.08 raised to negative 2. 1.08. I'm so sure some ninjas haven't seen where I've gotten 1.08 from. See, 1 plus 0.08 is 1.08. So then get out your calculators and punch. Everybody must do this. Everybody must be having a calculator. Punch there. 1.08 raised to negative 0. 1.08 raised to negative 0. Everybody. So we have here Bwana Daudi. It's 1. Lorna, it's 1. I hope everybody is able to see that. So this is 1. This is 1. This is 1. And then you go to 1.08. You see in your calculator, the raised to. The raised to is like this. In your calculator, the raised to is like that. Raised to. Yeah. So we have here Irua Joffrey 0.9259. Remember, these ones must be in 4 decimal places. 0.9259. Thank you so much. Thank you so much. Thank you so much. Thank you so much. And then now we have this one here, 1.08 raised to negative 2. So 0.79, 0.8573, 0.8573. Then we come to the last one. 1.08 raised to negative 3. 79, 38. 0.79, 38. Then come and create a column here for discounted cash flows. Create a column for discounted cash flows. Create a column for discounted cash flows. How do I get discounted cash flows? If this is column number 1 and this column number 2, to get discounted or A and a B, and this is C. So to get these discounted cash flows, you simply take A times B. Because it's cash flows with discounting factors. So the first one is minus 100 times 1. So this gives me minus 100. Minus 100. And then we have here 50 times 0.9. Is there somebody who's able to give us those answers very fast? Remember, for discounted cash flows, it's going to give us 2 decimal places. It's only PV that you have to give us 4. Discounted cash flows give us 2 decimal places. So 46.30. So we have 46.30. Thank you very much. Then we have here 40 times 0.8573. Margaret Wanjiro, 34.29. Can somebody confirm? 34.29. Geoffrey has been able to confirm this. And the last one is 30 times that. What are we getting, somebody here? 23.81. 23.81. So can you kindly give me the total? And whatever total we get will be your net present value, because discounting is present valuation. Discounting is the process by which we get this present valuation. So now you add, you start with minus 100 plus that, plus that, plus that. You give me a figure. Net present value is 4.4. It's 4.4. And it is positive. Whenever it's positive, this is the wealth which will be created. So whenever it is positive, the project is viable. Whenever it's positive, the project is what you shall say, the project is viable. If it is negative, of course, now that will be like a tick on some cow in a Fionza Damoto, right? So whenever projects have a positive NPV, we shall be accepting projects with a positive NPV. If it's a negative NPV project, you reject it because that will end up being a liability to the shareholders. It's going to become a liability to the shareholders. So if I were you, because this is positive, I would simply write in brackets here positive and therefore accept the project. Accept the project. Although, of course, this is an IRR question. I don't have to post like that. Now, ladies and gentlemen, please listen and listen to me very well. And I would want us to mention there. So that's number one, required net present value. And then now the second requirement here is that we should calculate the internal rate of return. Calculate the internal rate of return. So calculate the internal rate of what here? Calculate the internal rate of return. So the second part, they want us to calculate IRR. Internal rate of return. So internal rate of return is also known as the break-even rate of return. It's also known as the break-even rate of return. It's also known as the break-even rate of return. i.e., it is the rate of return at which a project's net present value equals 0. The rate of return at which a project's net present value equals 0. Equals 0. So then the question will be, how will we be able to get that rate of return that will be able to give us 0 NPV? It means, if for example, I want to get exactly 0 here through what we call interpolation, it means that I must be having a negative NPV and I must be having a positive what here? A positive NPV. Yeah, Kaburu, I'll be able to post this on the LMS. Yes, I'll post it. I'll post it. Yeah, I'll post it. So remember, ladies and gentlemen, I'm saying that for us to be able to get IRR, to be able to interpolate here to get a 0, we must have how many NPVs? And you're writing down there that to calculate IRR, we need 2 net present values. To calculate IRR, we need 2 net present values, semicolon. Number 1, a positive NPV, and then number 2, a negative NPV. So to calculate IRR, we need 2 net present values. We need 2 net present values. We need 2 net present values, i.e., number 1, a positive NPV, and then number 2, a negative NPV. Now, ladies and gentlemen, I'm so sure most of us, when we were very, very young, we must have been involved somehow in some physical fights. Is there anybody here who has ever gotten into some physical fight, kind of boxing or whatever kind of fighting, and you were fought down? Is there anybody who has ever been defeated in some fighting game here? When you were young, not today. Today, if you fight, I'll take you for a fool. But when you were young, during those growing stages, Is there anybody who fought and they were defeated? And they were defeated. Anybody who fought and they were defeated? Okay, Mike. Yeah. And from there, you learned a lesson, isn't it? You said, now from today, I will never ever fight anybody. I will never ever fight anybody because you got what here. So whenever they talk about IRR, we shall always be imagining that we are in a wrestling match. 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 So in this wrestling match, this will be Margaret Wanjiro at the center here. And then we have in this case here Bradley Mutol. Bradley Mutol. Bradley Mutol. So we have here a giant. A Gen Z giant. So we have in this case here a Gen Z giant. And then in this case here now we have another very short one here. Very short one here. Like that. So you are always at the middle here. At the middle here. And this match is quite a funny match. We are given some funny rules. We are told that we are going to play 2 games. You must play 2 games. One game you must win. The other game you must lose. The other game you must lose. So one game you must win. The other game you must lose. The first game we played here, we won. We got a positive. We got a positive. Now we are looking for a situation then where we shall be beaten flat. Remember, it's try and error method. It's called try and error method. So then I'm here. This is now Margaret here. This is Margaret here. So I've been told in this case here, I've won the first one. Now I want to be given a technical knockout. The question is, will I go for, if I want to be defeated, will I go for A? Will I fight with A or do I fight with B? If I want to be defeated, because you must be defeated in one game. You must be defeated in one game. Yeah, in this case here you go. So listen, whenever you have a positive NPV and you would want to be defeated, then you must come and try a higher cost of capital. You go for a higher cost of capital. There's also another way of reasoning this. Because if I try, cost of capital should reduce my profitability. So if I've got a near 4.4 and I want to kill this, to make it negative, then I will be able to try a higher cost of capital. I'll be able to try a higher cost of capital. So in this case here, you go, this tall guy here. So in this case, it gives you a technical knockout. You get what here? You go to negative. So remember, it's try and error. So this one here was 8%. So 8% has given us 4.4. Do we have somebody in this case here who is blessed? Somebody in this case who can give us, try this cost of capital and it's going to give us a negative. Because you see, if you try a cost of capital and you get still a positive, you will keep on trying until you get a negative. So do we have anybody who is always lucky? Anybody who is always lucky? So remember, what was this 8% here? This was 8%, which gave us 4.4. So in this case here, what do we try? What do we try? Double. Yeah. Yeah, I see you have an idea. Yeah, always try double. Of course, you can try. I would want other students in this case here to try 10%, especially students who are repeating here. If you're repeating here, I would want you to take a bold step and try, in this case here, different rate, because you have an idea. But the students in this case here who are doing this for the very first time, let's in this case here do with a figure that Mwalimu is using here. So we shall still borrow. So in this case here, calculate NPV using 16%, a higher cost of capital. Using 16%, a higher cost of capital. So here we have 0, here we have 1, here we have 2, here we have 3. We have cash flow. So cash flow, we have 100. We have 50, we have 40, we have 30. All right. Now I want this PVIF, which will be 1.16 raised to negative n. So 1.16 raised to negative 0. Raised to 1.16. because of the 1 plus R. I hope you guys are able to follow. Yeah, Ruth, I would want to see you using, so Margaret has given me already, the first one is 1. The first one, 1.16 raised to negative 0. That will be 1. The second one I want to believe is what Margaret is giving me, 0.8621, 0.8621, 0.8621. 0.7432, 0.7432, all right, 0.7432, and then we have 0.6407, 0.6407, 0.6407, like that. So then come and give me discounted cash flows. Give me discounted cash flows. So discounted cash flows, we are taking A times B. So minus 100 times this gives me minus 100. 2 decimal places. How about 50 times this? What are we getting? 44.605. So 0.61. Discounted cash flows, I prefer 2 decimal places. I prefer 2 decimal places there. Thank you, Gladys Chenge. So we have here 43.11, 43 no. So I don't know who to trust. Is this supposed to be 43.11? The people who have used 16%, I would want to talk to them. The guys who have used 16%, what are they getting here? The guys who have used 16%, or 3.11, the ones who have used 16%. Don't give us your figures if you used a different percent. Then we go to 40 times 0.7432. Yeah, 43.11, okay. 29.73, 29.73, 29.73. And then we have here 30 times 0.6407. 30, which gives me 19.22. I really pray that I will be able to get a negative. I really pray that I'll be able to get a negative. So minus 100 plus, I can see some light at the end of the day. Minus 100 plus that, plus that, plus that. What are we getting here? Hooray! 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 So minus 7.9, minus 7.94. Elizabeth, what do you mean? Which one did not? 16% has worked, Elizabeth. 16% has worked. Which one has not worked? Maybe use a different one now. Yeah. What was 16%? Tripata hiyo. Yeah. If you use tables, that would be very, very good, very, very easy. But purity, in most cases, your examiner nowadays will give you percentages here, which are not on the table as purity. Your examiner nowadays is a tough examiner. He simply wants to remove you from this bus going to KASNEB written pass. Yeah, and he's simply pulling you out of that bus. To make it even worse, throwing you under the bus. He wants you to die when he allows you to repeat 3 times. Very bad people. So you have to just know the long away purity. Yeah. 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 Okay. So are there guys who tried 12% and maybe they got a positive year still? Are there guys who tried 12% and maybe they got a positive year? Don't get tired. Always, and that's why you had from the very beginning. If the first one here, for example, in this case here fails, you double. If you try that double, it fails, now even triple. Right? Triple. Because it's trial and what year? Trial and error. Thank you very much, AAA. Or gives negative, very good. Now, then if you have positive, the positive NPV, call it A. The positive NPV, call it A. The negative one, you call it what here? Call it B. Positive, call it A. Negative. So come and give us IRR. How do we get IRR? So to get IRR, my friends, I'll take the lower rate plus difference between rates. Difference between rates. Difference between rates. Between rates here, right? Times A times A all over A minus B. So in my case, I've got two rates. The first one here, which is the lower one, minus B. B itself is minus 7.94. So remember, if you use 12%, you are making use of your figures. You're using your figures. So then I'll come and simplify this. So this will be 0.08 plus, so this and this is 0.08 times 4.4 all over what we can also call absolute sum. You simply take this and this will give you a sum. You sum. So this and this plus this. Is there somebody who is able to give me that sum? Yeah, great. Thanks, Margaret. Anybody who is able to give me this sum? 12.34. Now, once you reach here, then you can just use your calculator just once. You say 0.08 plus 0.08 times 4.4 divided by 12.34. Don't say equals in between. You simply say 0.08 plus 0.08 times 4.4 divided by 12.34. Then you say equals. Ah, Margaret is getting 10 point something, right? Whatever final answer you get, you can multiply it with 100. The final answer you get, you can multiply it with 100. You can multiply it with 100. Yeah, Chepkori, thank you so much. 10.85. So the students who used, for example, 12%, I'm so sure you're getting like 10.7 or 10.8. It may not be exactly the same like ours, but we should be able to get answers that are too close to call. Too close. Too close. Too close. Good question there from AAA. I mean, you can have like many combinations here. What you do, it is the concept of what here, the doubling. 8%, 16%. Don't use percentages are very, very close, very, very close. And of course, now this AAA would want some practice. This would want some practice. This would want some practice. All right. So I want to hear from the other students who use different percentages. Are they able to get, in this case here, an answer which is close? Those ninjas use different percentages than 16%. Where are those ninjas? Where are those ninjas? Where are those ninjas? Where are those ninjas? Is there anybody who used a different one and they're getting an answer that is quite close? Yeah, the answer you get will be very, very, very close. So, ladies and gentlemen, remember now RCM has partnered with HELB. Must have seen this. RCM has partnered with HELB. I wait for you guys to respond. This is a very, very important announcement because now this is the season to help our friends. To help our friends. So in this case here, KASNEB has partnered with HELB. Do what we call the KASNEB Foundation. And then of course now RCM is in their portal. All right. So if you want examination fees for KASNEB, tuition fees for RCM, including those registration fees, everything, you can easily get a loan. Like for example, for the RCM fees, these guys are giving you up to 60,000. Say 60,000, if you assuming you're doing 3 papers at a time, 60,000, if you're given this maximum, 60,000 can keep you at RCM for how many semesters? 4 semesters. Yeah. So again, if you get another 60,000 later, then you'll be able to clear. So of course, I know you guys have the capability. You don't need this loan, but there are brothers at home, there are sisters at home there, all right, who would want really to benefit out of this. Because, we shall be able to teach them like now the way we're teaching you from here. From Nairobi, we teach you guys from wherever you are. And you've gotten a loan that will be given a moratorium period of 3 years. You don't start paying immediately. You start paying after 3 years. And even after those 3 years, it is at 6%. I mean, it's unbelievable, all right, to wait for the 3 years to lapse. If you get some money, it's always good to pay your help. Remember, help is supposed to benefit the less privileged. So if you're benefited, always feel nice when you're paying. Finish your help loan as fast as you can. All right. So if you have got any friends out there who are interested here, all right, please, you can always do what here, reach out. Especially the students who are clearing ATD. When you clear ATD to CPA, there's a lot of exemption fees to be paid. We get situations where those students are able to stay at home, even for a semester or 3 semesters, to be able to raise that exemption. Now, KASNEB is giving you this money. And remember, depending on your case, like for example, people have got people who are orphans, right? So KASNEB will give you a loan and over here a bursary. So like by last week, we got students who are getting very, very good allocation, 60,000, 40,000, 45,000. Yeah. Even myself, I was not, we got into that portal a long time ago, but I was not believing in that. But when we realized that now people are started getting money, we took this now to be a very, very serious thing. So like now everybody should be able to take advantage of this before, because I know, like KASNEB right now, it has about 200 million. 200 million is not a lot of money. This money will be depleted very fast. Now that people have known, this money will be depleted very fast. Get these monies in good time. Not you, but of course your friends. Your friends who want to do CPAs like that. And ensure that they benefit. Ensure that they benefit. No. Purity, I don't think that is the reason, really. I hope, Purity, you're asking, like, for example, 1 plus 8%. Yeah. You see somebody will write here 1 plus 8%. 1 plus R. You can say 1 plus 8%. But when you're punching your calculator, you'll have to say 1 plus 0.08. Don't take it like 1 plus 8 is 9. Don't say this is 9%. No. It's 1 plus 0.08. That way then you will be okay. That way shall be okay. All right. Margaret used 12% and she got 10.7, which is very, very good. Which is really, really good. Really good. Really good. Really good. Really good. Gives the same answer. Thank you so much. Saidi Hapa, I'm getting 5.71%. So Lorna, am I able to get your NPV? Check this. Check this. I know it's body mass. Give me the rates. Lorna, give me the rates. What are your rates here? The 2 rates. The first one is 8%. What is your second rate, Lorna? What is your second rate, Lorna? The second one. 8% is the first one. The second one. Is it 16%? Or what is it? 16%. Okay. 16%. Then we have our NPVs. 8% is 4.4. And then 16% give us minus 7.94. That must be a body mass issue. So come and give us IRR, the lower rate between the two, 0.08, plus difference between the 2 rates. So 0.16 minus 0.08 times A. A is the positive one, 4.4. All over all over. At times we talk of absolute sum. Absolute sum is actually very good. So absolute sum means that you simply take this plus this, assuming this is positive. Loan body mass. So we have here 0.08 plus this and this is bracket. So this and this minus is 0.08 times 4.4. All over, body mass, this is like a bracket for the denominator. So then what is 4.4 plus 7.94? 4.4 plus 7.94. Lorna, are you able to give me that answer? You see, there is no way it can be 5.7. It can't be less than this. This is the lowest ever. It can't go below 8. No. This is the lowest ever. It has to be more than 8. So 12 point what here? 3. So I know the mistake. If you look at what Lorna did, you'll realize Lorna came and added this and this, and she said equals in between. She said equals in between. Instead of saying 0.08 plus 0.08, and then you continue the end, times 4.4, all over 12.34, and then you say equals, because your calculator has got body mass in it. Okay. But if you want to do body mass for it, you can first of all come and do what we call multiplication. You multiply first. You take 0.08 times 4.4 divided by 12.34. You multiply first, and then you add that answer to this 0.08. Now, I hope, Laura, you are comfortable. So I can see now we are 56. What time do you want us to finish the class? People have really run away from 63. I can see we are losing students. It's 10:06. It's 10:06. What time do you want us to? 10:30? I get it. Great. 10:30. Why 10:30? Do you guys get tired very fast? Do you have a problem that is making you become tired very fast? You can see I'm there. And I mean, I can go up to 12 very, very easily. And remember, I'm standing. You guys are seated down, right? Why are you tired? Why are you tired, Mbochi? And Mbochi, why are you tired? You are still young. I want to believe most of you are Gen Zs. You are Gen Zs. Why should you be tired? Yeah, please ensure that always, whenever you get time, you are exercising. You're exercising. Take lots of water. All right. And when you are studying at home, at times, in this case, you get used to even standing. You can stand up at times. You don't have to sit down like at 2. I can't sit down for 2 hours. Even when I'm working, I can't sit down for 2 hours. Even an hour, no. At some point, I'll have to go and get something. I mean, this is a laptop, a portable thing. You can stand up. You can move from sofa set to the table. I mean, you must make learning fun. You must make learning fun. And then, of course, you must avoid, like, in between classes, you get considered with eating lots of ugali, lots of starch. I mean, you will throw away everything and go and sleep. Yeah. In between, you can only take something like coffee, black coffee, like that. Diet really counts. Diet really counts. Okay. Yeah, I'll be able to share the timetable. I'll be able to share the timetable. Basically, okay.